How did a market watched by analysts, institutions, and advanced artificial intelligence systems collapse so suddenly in 2025? That's the question shaking investors right now. This crypto crash didn't come with obvious warning sirens or dramatic countdowns. In fact, many experts felt confident just weeks before things unraveled. The charts looked stable, narratives sounded strong, and risk models suggested control. Yet when the shift came, it came fast. And it caught almost everyone off guard. This crash isn't just about falling prices. It's about hidden assumptions, blind spots in expertise, and forces that don't show up in neat forecasts. In this breakdown, we'll uncover why even professionals failed to anticipate this moment and what really pushed the crypto market over the edge in 2025. Experts trusted stability that didn't exist. For months leading into the crash, experts leaned heavily on the idea of market maturity. Crypto had institutional money, better infrastructure, and widespread adoption. That created a sense of structural stability that simply wasn't real. Analysts trusted calm price action instead of questioning why it was calm. That assumption delayed defensive action. Once instability finally surfaced, there was no buffer left. The crash wasn't caused by chaos. It was caused by too much faith in an illusion of control that disappeared instantly. Liquidity vanished faster than models predicted. One major reason experts were blindsided was how quickly liquidity dried up. Most risk models assume liquidity fades gradually, giving markets time to adjust. In 2025, it didn't. Large players pulled capital almost simultaneously, and exits became crowded overnight. Bid-ask spreads widened dramatically, and selling pressure fed on itself. Experts misjudged how interconnected liquidity channels had become across exchanges, stablecoins, and derivatives. When one segment froze, others followed immediately. The system behaved more like a single organism than separate markets. By the time analysts recognized the severity, prices were already cascading. The crash accelerated, not because assets were worthless, but because buyers simply disappeared when everyone rushed to the door at once. Artificial intelligence signals were misinterpreted. Artificial intelligence showed risk increasing quietly, but confidence delayed action. The result was faster losses once reality overpowered interpretation. Institutional positioning created hidden fragility. Institutional participation was supposed to stabilize crypto, but in 2025, it amplified fragility. Large funds held similar strategies, risk limits, and exit triggers. When thresholds were hit, selling happened in unison. Experts underestimated how synchronized these positions had become. Diversification existed on paper, not in behavior. As soon as volatility spiked, automated risk controls forced rapid unwinding. That volume overwhelmed the market. Institutions didn't cause the crash intentionally. They reacted to the same signals at the same time. This collective behavior removed shock absorbers from the system. What looked like deep support turned out to be shallow when everyone relied on identical safeguards that triggered simultaneously. Investors rushed to convert, stressing reserves and exchange liquidity simultaneously. Experts assumed stability mechanisms would absorb pressure gradually. Instead, fear spread faster than verification. The moment credibility slipped, behavior changed instantly. This stress didn't stay isolated. It rippled through every trading pair connected to stablecoins. What shocked analysts most wasn't failure, but speed. Confidence broke before data could reassure anyone, and once that happened, damage spread far beyond initial concerns. Macro conditions turned against crypto at the worst time. The crypto crash didn't happen in isolation. It collided with tightening global conditions. Interest rates, credit stress, and currency pressures all intensified at once. Experts expected crypto to react independently, but capital doesn't compartmentalize during stress. Investors pulled liquidity across all risk assets simultaneously. Crypto felt it immediately, and that external pressure accelerated the internal breakdown. Derivatives magnified. Small moves into big losses. Derivatives markets quietly built massive leverage beneath the surface. Experts tracked headline leverage but missed how concentrated positions were becoming. Small price drops triggered liquidations that cascaded across exchanges. Automated systems acted instantly, selling into falling markets. This feedback loop amplified losses far beyond fundamentals. Analysts knew leverage was present, but not how fragile the balance was. When forced liquidations began, price discovery collapsed, Every drop triggered another wave. The crash accelerated because selling wasn't discretionary, it was mandatory. Once leverage turned against the market, control vanished. By the time analysts acknowledged the mood shift, behavior had changed irreversibly. Selling wasn't driven by logic, it was driven by uncertainty. That psychological turn accelerated withdrawals, reduced bids, and froze risk-taking. Experts didn't miss the data, they missed how fast belief can change. Once belief shifted, price followed relentlessly. Correlation spiked across assets without precedent. Another shock was how correlated everything became. Assets that usually moved independently fell together. Experts relied on historical correlation assumptions that failed under pressure. In crisis, diversification broke down. Traders sold whatever they could, not what they wanted. Crypto, equities, and other risk assets moved as one. This reduced escape routes dramatically. Analysts expected some insulation, but fear overrides structure. When correlations spike, protection disappears instantly. This wasn't gradual, it was synchronized. That's why the crash felt so sudden. Tools built for normal conditions couldn't handle extreme alignment. Once correlations converged, losses accelerated faster than anyone anticipated. Confidence in quick recoveries delayed action. Many experts believed any drop would recover quickly, based on previous cycles. That expectation delayed defensive moves. In past crashes, rebounds rewarded patience. In 2025, patience became costly. Early warning signs were ignored because history suggested resilience. But markets evolve, and past playbooks don't always apply. This crash punished delay. By the time experts realized recovery wouldn't be immediate, prices had already adjusted sharply lower. Confidence in a bounce kept exposure high too long. The difference wasn't intelligence, it was timing. Relying on familiar outcomes blinded experts to changing conditions, making the downturn far more damaging than expected. Risk models assume time that didn't exist. Most institutional risk models assume time to react. Stop losses, rebalancing, and hedging rely on orderly conditions. In 2025, events unfolded faster than models allowed. Gaps replaced gradual declines. Automation reacted instantly, but oversight lagged. Experts were prepared for stress, not compression. When decisions must be made in minutes instead of days, systems struggle. The crash exposed how dependent experts were on orderly markets. When order disappeared, models became outdated instantly. Risk wasn't miscalculated, it was moving too fast to calculate. This mismatch between speed and response is a key reason experts couldn't keep up. Everyone expected risk, just not all at once. In hindsight, the signals were there, but they were scattered. Experts didn't expect every weakness to activate simultaneously. Liquidity stress, leverage, psychology, and macro pressure collided at once. Each risk alone looked manageable. Together, they became overwhelming. This convergence is what made the crash shocking. Systems are designed to handle isolated failures, not synchronized ones. When everything broke together, reaction time vanished. Experts weren't ignorant, they were overwhelmed. The crash wasn't unpredictable, it was compressed. Understanding that difference matters. When risks align, markets don't warn loudly. They collapse quietly, then suddenly. The 2025 crypto crash wasn't caused by one mistake or one bad actor. It was the collision of speed, confidence, and hidden fragility. Even experts missed it because they were looking at parts, not the whole. This moment reminds us that markets don't fail loudly at first. They weaken silently. If this breakdown helped you understand what really happened beyond the headlines, support the channel by liking, sharing, and subscribing. Drop your thoughts in the comments. Your perspective adds value to the conversation. Stay alert, stay disciplined, and stay connected, because understanding these moments is how investors prepare for what comes next, not what already happened.